says elephants can't dance. Now, the latest quarterly performance of SBI is aptly summarized by this title of the memoir of Louis Gerstner, who served as the chairman and CEO of IBM back in the 90s. He was credited with bringing the company back from a near-death experience. Now, SBI has posted a stellar show with net profit surging 74% in the second quarter. The bank reported its highest ever quarterly profit, backed by strong growth, margin expansion, controlled operating expenses and lower provisions. Also, the treasury gains and absence of any one-off expenses boosted profit growth in the second quarter. The asset quality cycle turned favorable for SBI since the last couple of years. Now, it has showed further improvement in Q2 with GNPA ratio declining to 3.52%. Now, SBI has also seen a slowdown of bad loan formation as slippage, which had moderated in the last couple of years, fell to a record low in the second quarter. Thanks to low slippages, credit cost and provisions have fallen further. And despite the significant decline in credit costs, the provision coverage has improved. The key question is whether the record low credit cost can be sustained. And more importantly, what will drive the earnings growth in the coming year? SBI's asset quality is likely to remain upbeat as legacy corporate stressed accounts are fully identified and well provided for, which includes the likes of Future Group, SR Group, etc. SBI's restructured loans are at a mere 0.9% of the loan book as of September. While the regulations require banks to make provisions amounting to 10% of total restructured book, SBI is carrying 30% provisions for its restructured loans. Moreover, special mention accounts at below 0.5% of the overall advance book is indicative of less asset quality pain in the near term. SBI continues to surprise on the loan growth. The bank's retail growth has been strong since many quarters. Add to that, there was a sharp pickup in corporate credit in the second quarter as well. But the real showstopper was the robust growth in corporate lending. Corporate book, which constitutes 36% of SBI's domestic loan book, grew by 21% YOY in the second quarter. The massive rise in government's capital spending, as proposed in the last union budget, along with the PLI scheme for manufacturing, will aid in the revival of the capex cycle. And the kick-starting of capex cycle will provide impetus to SBI's loan growth and will drive its earnings. The rising interest rate environment will support SBI's margins in the near term. And loan book will get repriced quickly as bulk of the loan book is floating in nature with yields linked to some external benchmark. Deposits will get repriced with a lag effect as 45% of the deposits consists of current and savings account balance on which costs are fixed and least likely to change with rate movements. Overall, SBI's top line is likely to be strong on the back of healthy loan growth and better margins. This, together with buoyant asset quality, will drive the earnings growth in FY23 and FY24. Thanks to strong internal accruals and capital raised through 81 bonds, SBI remains adequately capitalized. Now, if the current loan growth momentum sustains, the bank may be required to raise equity capital. Meanwhile, the bank's digital platform YONO has seen good traction during the quarter. The bank disbursed over 7,900 crore rupees worth of pre-approved personal loans through YONO in the first half of the current fiscal. Around 62% of the savings accounts were acquired through the YONO platform in Q2. Now, despite the recent rally, the stock is trading at one-time core book value estimated for FY24 and is attractive considering return on asset has reached 1% in the quarter gone by. Now, given its sheer size and the leading market share, improved return ratios and the end of the NPA cycle, SBI should command higher than its long-term historical average valuation multiple, which would be around 1.3 to 1.4 times forward book. The improving performance of the bank's subsidiaries should also help drive the stock upside. Following the rally in Indian equity markets, valuation of many stocks across sectors are discounting multi-year growth opportunity. But this is not the case with SBI. Long-term investors should buy SBI to gain from the next leg of re-rating.